Brian Huerta, welcome. It's great to have you on the Hewison Private Wealth Lunchtime is Money webinar series. Very excited to have a chat.
Thanks very much. I'm really happy to be here.
And that's good. And just to set the scene and jumping straight into it, where are you? You're in Laguna Beach, is that correct?
We're in Laguna Beach, California, down in the southern part of the state. Yes.
Yeah. Fantastic. So, I mean, Hewison Private Wealth were sort of, well, I'll say early investors into WCM back in early being 2017, but WCM has in fact been around for a lot longer than that. So I'd really love you, if you could, Brian, to introduce WCM and just talk a little bit about the brief history and how your team's made up over there.
Terrific. Well, first of all, thanks for your support. You're right. WCM has been around for quite some time, as early as the mid-'70s. At that point, it was owned by one person and never really got to any scale. It was a small money manager, about $300 million is where he maxed out at. And it was run a certain way where it was just one person at the top. He made all the decisions. He controlled the business. He had all the economics in the business. So for 20 years or so, he managed it as such during a period where there was tremendous growth in asset managers, but yet he never grew it. We think for a couple of reasons. There are a few different lessons that we learned because of it. In 1998, he decided to hang them up, and 4 partners bought the firm, 2 of which are still at the firm, Kurt Winrich and Paul Black, our 2 co-CEOs. And a little bit tongue-in-cheek, but they decided, at that point, let's do everything the exact opposite way that it was done over the last 20 years, because that way wasn't working. It was very obvious. It was a revolving door with respect to talent. Nobody was happy. It was kind of, you got here at WCM and then you were already looking for your next job, and it was kind of viewed as a stepping stone. It was a nice place to live. It was a comfortable living, but it really didn't inspire minds to really grow the business. So Paul and Kurt really set out to just turn the firm really upside down, and they did that. In the 2000s, they really laid out, I think, an investment philosophy and a plan, and tried to start building out the culture. They started slowly. This is a long haul. So in 1998, it was what I consider kind of the reboot of WCM with new philosophies. During 2000 to 2010, we had mixed success at best. This was a time when there was a lot of technology innovation. We started to invest in companies that we thought were going to emerge as leaders. We made a lot of mistakes. And as we got to the middle to end of 2000, we made even some more drastic changes to our investment philosophy and our process. And that's what kind of puts us to where we're at now. I would say that process started to be refined in the mid-2000s and really hit its stride maybe around 2009, 2010, when we started to pick up new assets and embark on a new journey that we've been on. And currently we have a little bit north of 60 billion US dollars under management. About 65 employees, most of which are in Laguna Beach, California.
Fantastic. And so that's a great segue, I guess, into the next question. And so I'd love for you to introduce to the listeners and viewers today the WCM investment philosophy, and just talk about, I know it's quite a unique research process, and it's quite different to some of the other managers that we might be familiar with. So, obviously you talked about how you pivoted over the journey and come to, I suppose, the philosophy that's held you in such good stead today. So I'd love for you to just to sort of, if you could explain that to us, that'd be great.
Sure. The journey definitely led to a lot of humility in the process, but philosophically, from a high level, we're long-term investors. We really want to partner with businesses over the next 5-10 years or more. And that's important because when you have that type of outlook, you ask a different set of questions to the companies, and you ask different questions to yourself as to how you think about investing. We're also concentrated investors. We've learned that over the years that you don't want to encumber the portfolio with your 50th or 60th best ideas. If you could find that right number, which we define as 30 to 40 high conviction ideas, that's the right number. Again, don't want to saddle the portfolio with stocks that we just don't have a lot of conviction in. So we set the bar purposely high. And thirdly, philosophically, is we think we got to protect our clients' assets in tough markets. We have a long history of what is called preserving our downside capture. And that simply is if the market is down 10% on average, and historically we've been down about 7%. So far better than what the market experiences during that downdraft. That downdraft's always going to happen. Sometimes you don't know what's going to drive it, but we don't hedge our exposure. It's through stock selection and portfolio construction that we're able to deliver that 70% downside capture. That's really important too, because when markets do eventually recover, because they always do, you're working from a higher base. And the last thing that is oftentimes overlooked is the impact on temperament. If you don't have that discipline on downside capture, it wouldn't happen at WCM, but for other growth managers, you get deep into the hole, you start making decisions that you wouldn't normally make because you're trying to play catch up, and especially at the end of the year. That's just not the way we do it here. And so that's an important part. You really, that is sometimes overlooked, to understand what some of these guardrails are, which we'll talk about in construction, that helps prevent us from digging that hole and trying to work ourselves out of that.
Sure. And I mean, I know I grabbed this paragraph off your website, but it's certainly when Hewisons were introduced to WCM, it certainly resonated a lot with us. But on your website, you say your primary goal is to generate long-term sustainable excess returns for clients through a culture of innovation, close alignment of employee incentives with fund objectives, and a flat power structure that fosters meritocracy and debate. Would you care just to elaborate and expand on that statement?
Yeah, sure. Well, I kind of tipped my hand a little bit about how our co-CEOs really just wanted to turn the place upside down. I mean, they set out an agenda really to build an organization that would thrive, would be unique, would be a place that people would want to work, but also that would be free of any egos or star PMs. They'd want an environment that would encourage debate, free thinking. Work without fear is something that we talk about. And that to me, that to us means being able to challenge anyone within the organization and not be fearful of perhaps, getting something wrong, but learning from mistakes. And so it's just a totally different mindset here at WCM than at other asset managers or versus our peers. And it's something that we spend a lot of time on. And I'm glad you asked the question, because oftentimes we don't get an opportunity to talk about our own culture, but it's very important. What makes us unique. We do think that the risk of asset managers is people leaving the business or leaving out the door. And we share in the economics. Nearly half of the employees here at WCM are also owners in the business. The owners didn't need to do that, but they want to share the economics because they know that if we're long-term investors, we need to be aligned as such, and we need to have people who are here for the long term. So we want to share in that success and want people to feel like there's an owner mentality here at WCM and that everyone is contributing. So it's a tight group at WCM, and we're all striving for the same thing.
Fantastic. And we've been privileged to, some of us, to go and visit WCM in Laguna Beach, and I think I unfortunately couldn't make it, but I believe some of my business partners might have been presented with a pair of flip-flops when they arrived, which we call them thongs here in Australia, but I know that's not quite how you refer to them. That means something else over in the States. But it's Laguna Beach being a surf town. I'm a surfer, so I know a surf town. It's you keep quite a relaxed culture down there, don't you?
We do, and it's partly working without fear is like we all trust each other that if you want to wear flip-flops, go right ahead, because we know and trust that everyone here is working hard. It's quite a different place. People really enjoy what they do, and so while it's relaxed, people work really hard because they love it. This is what they love to do, and they enjoy being around each other. And so while somebody may take a break to do yoga in the middle of the day or go for a surf, they're working quite hard. And people often work into the evenings and on weekends. We don't have a set vacation policy, but nobody abuses it. It's that philosophy that if you hire the right people that are really passionate about investing and everyone is working together, we could just shed ourselves from some of that stuff that infiltrates asset managers or stiff and bureaucratic workplaces. It's just not who we are.
Fantastic. Thank you. Now, getting into some of the nitty gritty, Brian, when we talk about global markets, it's difficult not to be drawn to the US, given its sheer size and the making up, effectively 50% of the global MSCI. It recently, the US markets recently hit another high. Could you help us understand what's really driven this? Because, I think we would all agree that if you did try to make macroeconomic predictions and what would happen to markets, this probably wouldn't have been one of them at the start of 2020.
Yeah, well, I like how you finished that question, because making macro predictions are very difficult to do. Very few people get them right. I say it kind of tongue in cheek, but if people were really good at it, or there would be more macro funds out there. That's what I'll say towards that. But you're absolutely right.
No, sorry, I know I used the word macro. Could you just help everybody understand, just to be very clear, the difference between macro and micro in an investing sense?
Oh, sure. Macro. When we think of the macro, that's more of the broad strokes of the economics of the business. Are we looking at interest rates? Are we looking at GDP rates? Are we looking at monetary and fiscal policy? Are we looking at currencies? Things like that really drive asset class decisions and things that might affect those type of allocation decisions. Micro is more driven on a company to company basis. What drives free cash flow and earnings and businesses and competitive advantages, and so we're more focused on those type of things in our process as opposed to macro. I will say we are macro aware. We're not head in the sands and not paying attention to macro, but how we think about macro is to understand maybe what some of those risks are, but we don't overinvest or won't overinvest time in macro because the return on that time just isn't very good, nor have we ever been really good at predicting macro. We often will ask ourselves if we got that right, even if we knew where the direction of rates were going or GDP or economic activity, what would we do with that? And is that what our clients want us to do? And we struggle with that, even if we were to get that right. And there's some very smart people out there making predictions on the direction of the dollar, for example. And sadly, oddly, too, that they oftentimes don't get that right. We try to focus on what we think our core competency is. It's a result of a lot of lessons learned, and that is to focus really on the micro level business drivers as it pertains to the companies. We do keep track of the macro, but it's really the focus is on the micro.
So what's driven this all-time high throughout 2020? Seriously.
Yeah. Well, it's been a head scratcher, I think, for many. There's no denying that some of the monetary policy that we've seen as a result of coronavirus has led to a nice liquidity boost in the arm for the U.S. markets. That certainly has been the case. Also, companies that the U.S. markets are very tech driven, and the shift to work from home pulled in a lot of demand for tech and for growth. And so certain companies have actually benefited from this spending in tech as a result of work from home and e-commerce. If you can't go to get your groceries or purchase things that you might need, just household items, that those dollars shift to online. So that's certainly helping the fortunes of companies like Shopify or Amazon.com or Mercado Libre in Latin America. Also, if you're working from home, you're going to need to, your companies or your organizations that you work for are going to want to ensure that the networks are safe and that they're well built and that you could access, and we could do things like we're doing now. That's led to some increased spending on the IT side. So the markets have been helped by that. The shift to work from home certainly has caused weakness in certain categories, but has helped others. And no denying that some of the response to the virus has helped from a liquidity perspective the U.S. Markets.
Yeah, sure. So do you believe, and I don't know whether WCM take a view on this, but do you believe the market is overvalued, or is it simply a case of, those tech stocks that you alluded to leading the way, but other areas of the market are still recovering? So are there sort of, multiple speeds to this economy in terms of, to your point, those that are outperforming, are there still some that are, obviously underperforming, etc., or do you overall believe that the market is overvalued?
There's certainly corners of the market that are overvalued and are trading at pretty rich multiples. We're aware of that, and there are certainly some parts of the market that we still find quite attractive. We're still very bullish on the portfolio and the number of opportunities that we see. We do look at valuation, but it's not the number one part of our criteria. We look at things before valuation, like competitive advantages and corporate culture and underlying secular growth trends. The market certainly is riskier now than it was in February and March. In February and March, we were quite active in the portfolio. We were upgrading the portfolio with respect to quality. We saw certain stocks that we've had on our watch list for quite some time derate their multiple 40, 50% in a matter of a couple of weeks. We were aggressive buyers at that time. That really set us up well in Q2. At this point, we have been paring back on some of the big gains that we have earned over the second quarter to take some risk out of the portfolio. We have a pretty well-defined construction process of 50% defensive growth, 30% secular growth, and 20% cyclical growth, which we'll spend some time on in this discussion as well. That's an important part of how we put together a portfolio. But that keeps us properly exposed or balanced, I think is a better word, to different growth drivers. So we're not overexposed to maybe the higher multiple, most expensive parts of the market, and rooted more into the defensive growth strategies or different defensive growth companies that have more palatable multiples and that are very durable and have very long-lasting secular trends underneath them.
Could we just carry on that theme then and just roll straight into that, because you've started to talk a bit about your portfolio construction, which I think some of the viewers would be very interested in. I certainly am. And also, and you highlighted a little point that I wanted to make sure that we touched on today. And that is, we've talked about culture in relation to WCM, but I also am very aware that looking at corporate culture within the businesses that you look to invest in is also really important. So there's probably a bit in this discussion, if we could sort of just start with, essentially, as I said, you said before, you've talked about the way in which, the way you look to start constructing your portfolio. So could we roll into that? And then also perhaps, I know some of the viewers would love to hear of some of those, examples of companies who you've either, let's face it, made a lot of money in, this year, or also looking to invest in because some of those multiples have pared back?
Sure, happy to. Okay, well, let's start with portfolio construction. This is not this is a global growth portfolio, and it's a concentrated portfolio. So you might think that that's quite risky, but it's actually well constructed, so it mitigates some of those risks. As I mentioned, about 50% of the portfolio is in what we call defensive growth. These are what we consider our anchors to the wind. These are very stable, strong, durable companies, oftentimes have very visible revenues. They work in a lot of different environments. We use the term moats, which we'll talk about more in our process, to use kind of a similar analogy. They've been battle tested, their moats have been attacked, and they've been able to withstand and grow. So they often have very attractive industry dynamics as well that enable them to generate outsized returns. And so that's about half the portfolio. And these are really solid companies like Accenture, which is essentially an IT service provider and a toll booth on technology spend. The 30% that goes into secular growth gets a lot of the headlines, and we hear a lot about these stocks, and they're all very exciting, but we really try to keep it around 30% of the portfolio. It might be plus or minus 5%. And these are the most innovative, often fastest growing companies that we could find that are really driven by the most inspiring CEOs that are going after the most open-ended markets and growing the fastest. And the bar's set quite high for these companies because inherently they carry more risk. The number of outcomes that could happen is much more wide. But these are companies that we think are best in class and the most innovative that we could find. And then third,
maybe a quick example.
Sure. Shopify, Mercado Libre, or Lululemon would be in this category. Again, about 30% of the portfolio. Shopify is an e-commerce enabler, helping mostly small and medium-sized businesses build digital storefronts and providing a total platform and ecosystem for them to quickly, within minutes, get on the web and be able to fulfill orders or take orders, accept payments, and even in some cases fulfill orders. Mercado Libre, the easy example, it's an Amazon.com plus fintech business similar to PayPal in Latin America. They really dominate the markets in Argentina, Brazil, and in many areas in Mexico. And Lululemon is, as you may know, is a specialty retailer based here in North America and Canada that is doing quite well with athletic technical apparel.
Let me assure you, Lululemon is almost on every street corner here in Australia as well.
Okay, very good. Yeah, we know their aspirations are quite strong in Australia as well. So that's about 30% of the portfolio. Then that remaining 20% is what we consider our cyclical growth bucket. And these are companies that not only are cyclical, but have structural advantage. But they are a little bit more sensitive to the economic or business cycle. They might be more exposed to producing manager indexes or ISMs, and oftentimes have a little bit more operating leverage. They might benefit in a recovery scenario, a recovery environment. So they give us a little bit of exposure to that as well. So this is quite different than many growth managers and how we construct the portfolio. We think it gives us a lot of good balance. It helps us manage risk, and it's also incredibly resilient. It helps us get to that downside capture of 70%, but also deliver upside. We have a long-term history of delivering better than benchmark returns. And it's a combination of stock selection, I think, this portfolio construction that really helps us get there.
And just picking up on, we were talking a bit earlier about culture, and I just think it's really interesting and something that the many viewers and who would be investors in WCM may not be aware, just around when you go in and talk to the CEOs and the senior executives of these businesses. It is. I feel like it is something that's unique to WCM in terms of that your focus on the company culture as a driver of your investment decisions. Could you just elaborate on that a little bit?
Sure, happy to. Yeah, I think it really differentiates our story. We started this journey around culture in the early to mid 2000s. It was first initiated, as I mentioned, through our own experience with the buyout and thinking about, well, what kind of business do we want to build, and how do we make it enduring and lasting, and how do we inspire and motivate, and how do we do it if we just start all over again? So that's how we started this journey with culture. But if I could take one minor step back, yeah, the culture is a key part of our process. We didn't get a chance to talk about competitive advantage, but we'll circle back to that point. But culture is a key ingredient, we think, to long-term success. And it's often overlooked. It's overlooked, we think, by our peers because it's very hard to model. It's very difficult to put in an Excel and say, this is the value of that culture. Culture is something that is done every single day and nobody notices at the company. It's a way of doing business that is difficult to quantify, but so important. In our research, it often separates two businesses that look the same, working in the same industry. One has a superior culture and one does not. And the one with the superior culture earns multiples over the one that does not, in terms of returns on invested capital, operating profits. They just have a totally different output because of it. So what are we looking at when we're looking at culture is three things. And at a high level, we're looking for cultural strength, adaptability, and alignment. Cultural strength is a little bit as what it sounds like. If you were to ask 10 people at a company, if 9 of them said kind of the same thing, it's like, this is what is really important at the company. It's clear that there's a mantra, there's a way of doing business there that is crystal clear. Oftentimes it's a rally cry. It's what the company does when the road gets rough. It's what animates the culture. It animates the business. It's what enables the company to move along. The adaptability portion of culture really refers to, is it when challenged, does a company find a way to get back on proper footing? I think about Lululemon, since we mentioned that earlier, and you seem to be familiar with it. You might remember a few years ago, they had an issue with some of their stretchy pants, and when someone would bend over, it would expose them, and it was a manufacturing issue. They were able to bounce back from that very quickly. Their former founder and CEO made some remarks about people that were less than flattering. They were able to bounce back from that. We were pleased with those comments, but it was amazing how well the business recovered. So there's a certain level of resiliency. There's a certain level of learning from past mistakes. There's certain ability to look at all their competitors and learn from what their competitors are doing. We do think that that's quite important for our companies to know exactly what their competitors are doing. So that's the alignment portion. Then lastly, and very importantly, that was the adaptability portion. The last portion is alignment. If the company's strategy is to be the leaders in technology, we'll take a look at, well, are they spending their R&D dollars to support that? Are they hiring the right people, the engineers? Are they developing the right products? Are they looking out 5 to 10 years? If you want to be a technology leader, you often have to think in 5 to 10 year increments. So that's how we think about alignment. Does a culture support the strategy? Is what we're really looking for. Does it help extend the moat? And that's that we sort that out by looking at how they allocate their capital, how they incentivize their employees, how they're structured organizationally, to really see how strong that alignment is. But this is an important thing that we think is often overlooked. You could get really stuck into the numbers, but there's still a lot of qualitative judgment that you need to make about organizations that really help differentiate if you're a long-term investor like we are.
Sure. Just want to challenge you on one point, but I think, you mentioned a portion of the portfolio being invested in companies that are durable. And I suppose one of the situations that has arisen out of the COVID-19 pandemic is the fact that no one saw it really, no one saw it coming. And it's impacted some sectors, industries, and individual companies that previously we might have thought were very durable, long-term performing businesses, with great systems, processes, cultures, etc. But I mean, they've literally just been caught right in the middle of this tornado. How do you navigate through that? And the question, the second part of that question is, there's a tendency for a lot of people out there to say, well, the post-COVID world's going to be a lot different to what it was before. Things have changed, and let's keep jumping on, putting more money into these tech stocks that are obviously going through the roof at the moment. Surely there's got to be some really, really good opportunities that are going to present themselves when we return to a COVID normal. And are they in companies that at the moment are just completely out of favor? And are you seeing any of those?
Yeah, let me just address like culture and in a time of crisis. Oftentimes, that's when the culture comes to the very top. It's a little too late to work on your culture when you're in the middle of a crisis. So we think building a strong culture and having a strong culture really gives our companies and their businesses downside protection. A key part of our culture work is around adaptability. And so when something like this happens so quickly, we've never really had something like this, the companies that are able to adapt quickly are often the best positioned to benefit from that over the long term. I'll give you an example. Shopify is one that had an amazingly wild ride in terms of its narrative. In the middle of Q2, investors in the market felt like Shopify is done. They help small and medium-sized businesses. Those businesses are going under. And quickly, you saw just the opposite happen. Those businesses needed Shopify more than anything else. They quickly, if they weren't already, needing Shopify to get on the web, not only to survive, but then also thrive. And so they benefited from that. And Shopify did several things during the crisis to extend their hand to them as well. A couple examples, they announced a few new partnerships to help expand and generate demand from Facebook and Walmart, which was very important for many businesses. And secondly, they also did some things on the lending side, essentially, providing microloans and some capital to merchants so they're able to get past and help them through the cash flow squeeze that they were having for a couple of months there. So to us, that just shows a lot about their focus on the merchant and also pushing out their own profitability. They didn't take up their take rates. They try to do everything they could to focus on their customers' viability as opposed to gouge and try to extract as much profit as possible. So we think that's a good strategy, and that's just an example of how culture matters, especially in a crisis, and why it oftentimes could be your most important competitive advantage.
Yeah, fantastic. And also just sort of, looking at, I guess, the future from here. And as I said before, and as we've talked about, the news is awash with tech, with the role that tech stocks have been playing. So, I mean, if I put it another way, would WCM see themselves, would you see yourself as more of a value investor versus a growth investor? Because, I mean, the tech stocks are really, they say if there's a battle between value and growth is winning right now. Sure. There's also a belief that and maybe it's wrong. Maybe the FANGs are going to keep continuing to roll ahead. But would you classify yourself as a value investor? And I suppose coming back to some of these opportunities that might be sitting outside of the tech sector, are you seeing any value opportunities?
Sure. There's a lot there, so let me try to address this. We're quality growth investors.
Okay.
And that's still quite different than beta and momentum investors. Just to be clear too, I think a lot of the stocks that you see in the news wouldn't be in our portfolios because of our quality filters, if you will. We're super selective on what we choose to have in the portfolio. It's a best ideas portfolio, and it's competitive to get in the portfolio. Our idea around quality isn't just about how fast it could grow, but also about its competitive advantages over long term, and also culture, as we mentioned. But we certainly are quality investors first, in the traditional sense, meaning low debt and high returns on equity or invested capital. But much more than that, there's a lot of qualitative inputs. Those, to me, the quantitative side that I just mentioned, that's the output. But the inputs to what makes a quality idea is things like those competitive advantages that I mentioned. They're what's driving the business versus their peers. It's the scale that they have. It's the fact that they're able to do it at a low cost. It's the relationships that they have with their customers. Those are the things that drive quality for us. That's how we view it. But we're quality global investors. That's our core competency. Wouldn't consider us value, but it's not just tech that we're investing in too. We invest quite a bit in healthcare, consumer. We have some niche industrials, and we have some financials as well. Our financials exposure is more niche and more data driven, more services driven, as opposed to banks and lending institutions. But we're certainly not a all tech all day in all the portfolio. It's much more measured than that. It's quality growth driven by a lot of different factors, and it's not beta and momentum. It's bottoms up durable growth.
Sure, fantastic. I've got one more question, and then I'll roll into a couple of questions that have been raised by some of the Hewison advisors, and we'll roll through those pretty quickly because I'm conscious of time. Is WCM? Are you always, as long-term investors, are you always fully invested, or are there times if you do feel that the timing's just not right, or you've taken some profits off the table and you can't see any opportunities, immediately? Do you ever keep higher allocations to cash, or do you always maintain the portfolio is always fully invested?
We're fully invested at all times. At any given point, it could be anywhere between 0 and 5% of the portfolio in cash. That's usually a result of maybe we've lightened up on a position and we have some dry powder and we've yet to put it to work. But we don't make any allocation decisions towards cash regarding the market. We leave that to the investor. If they choose to have a portion of their total portfolio in cash, we leave it to them. But when you own a WCM fund, you can expect it to be fully invested at all times, and fully invested to us is between 0 and 5%.
Fantastic. Now, a question from Chris Morcom here at Hewison's. The US election, it in some respects, I guess it's got macro implications. So you may not spend a whole lot of time worrying too much about it, but does it play into your thinking, and what should investors be doing, if anything, with this huge event on the horizon?
Sure. Well, our expectation is that markets will get and become more volatile up to the election and quite possibly after it. That's what we could expect. We've looked at our portfolio. We've looked at some of the comments from both sides in terms of what our priorities, and we don't feel like any of our stocks or sectors have a bullseye on them or are in the crosshairs of any significant political risk. But you're absolutely right. We're not going to spend an enormous amount of time around that because it's just, quite frankly, it's just really unknowable what could happen and for how long. So we're going to stick to finding the best companies, be aware that there is an election coming up, and understand, which of our stocks or sectors might be more vulnerable. And we feel like we have a handle on that, but we're not making any wholesale changes in anticipation or in advance of the election.
Sure, great. Pierce has asked, and you alluded to this before, that almost 50% of the portfolio is invested in IT and healthcare. Has that always been the case, sort of over a longer period of time, or has that been more of a deliberate shift during 2020?
Yeah, it's occurred over years. It's not deliberate. We don't have a minimum or a target percentage of the portfolio in tech and healthcare. It's evolved, several years ago, anywhere between 3 and 5 years ago, we had a higher percentage in consumer staple stocks. And for a brief history, those stocks kind of lost their luster. They were vulnerable. They became more vulnerable to private label. Very much disrupted through online and direct-to-consumer stuff, and they actually got quite expensive as well for quite some time. And so they weren't as defensive as they once were, and so we started shifting out of consumer staples. So it's really bottoms up. It's where we find the best opportunities. It happens right now to be a little more tilted towards tech and healthcare, but that may change. It has been different in the past. And we're still seeing a lot of really good businesses in those two areas. But what you won't find in the portfolio is utilities or commodities in any major way or ever. Sometimes we'll have companies that are what we consider niche industrials that might be chemicals or materials related. Ecolab is quite a unique story, and that's classified as a chemicals or materials company, but that's more of a service business that has high barriers to entry and is high visibility revenues, and they really just dominate the cleaning and sanitation business. So you could expect from us growth sector investing, which is predominantly tech, healthcare, consumer, and the niche areas of industrials and financials.
Okay, fantastic. Good segue to my next question from Alison. Within your top 10 holdings, which if I read correctly, make up about 30, as of the end of July, made up 38% of your total portfolio. No Apple, Microsoft, Tesla, Netflix, Facebook. How come?
Yeah, we have owned all of those stocks at one point, and that's it's a nice segue too. Yeah, to our process. We always challenge ourselves, like what is our edge, or how do we view things differently? What is our variant perception is the word that we use internally. And if we feel like we really don't have one, it fosters debate. It encourages a discussion because we don't want to be like everyone else. You're absolutely right. We don't own any of the FANG stocks. The last stock that we owned that was a FANG was Netflix, and that was when we started to lose a little bit of conviction in late last year, and we ended up selling the stock on some strength earlier this year. Now, you could have argued that you should have kept it. Work from home has led to a lot of people on their couches binging on Netflix stories. But we felt that the competition was starting to erode their competitive position, and that content prices were continuing to escalate, and we saw new streaming mediums on the horizon that seemed to be catching on. And so we had a little bit more concern around their moat, their competitive advantages. So that's what led us to sell Netflix, and we had some other ideas in the hopper that we were really starting to grow in our conviction. So it's a couple fold. We have a tremendous amount of respect for those businesses. We've liked them all. We still do. We just we have felt that their competitive advantages may be stagnant or declining, and we had better ideas. And we always ask ourselves, how do we view this business different than our peers? And if we really don't, then it catalyzes a discussion on should we own the stock if we think just like everyone else.
Yeah, fantastic. Well, look, that sort of finishes up the questions, and I'd add, and probably almost in a closing note, we're aware that WCM has been around for a very, very long period of time, and the very long-term returns of the portfolio are exceptional. And since 2017, June 17, the portfolio has returned 22.5% per annum for investors within Australia. So you're clearly doing something right, Brian. There's no doubt about that. I just want to thank you very much for your time today. You've been, incredibly generous and open. I've certainly got a lot out of it. So, and I'm sure that the viewers have as well. So I really appreciate your time.
Thanks so much for having me. Yeah, thank you. Thanks for giving us the opportunity to kind of describe how we're different. We certainly philosophically believe that we can't do it like everyone else and expect a different set of results. So we touched on a few things. We certainly think that qualitative factors matter a lot in the investment process. There still is an art to this, and we're going to continue to do it the way we have. And we just thank you for your support and joining us for this.
Thanks, Brian. We'll talk to you soon. Cheers.
Take care. Bye now.